My dear FK students, today I am going to explain the ratio analysis. This is a very important examination point of view because in recent examination they asked for 10 marks from the chapter. The chapter purely based on the formula based chapter. If you know the formulas very well, you can solve the problems very easily. Finance statements of companies are format based chapter, but ratio analysis is formula based chapter. So if you know the formulas very well, easily you can solve the problems. In recent examination they asked for 10 marks. So that is without ratio analysis there is no question paper at all. So now I am going to explain the ratio analysis. Then this is a L1 assignment related aspects I am going to explain now. But before that I am going to explain the formulas ratio analysis. So first the name of the chapter is ratio analysis. What is mean by ratio? Ratio, it can express the relationship between the two interrelated financial variables in a mathematical form and meaningful manner. So that means it can establish the relationship between two interrelated financial variables. So in a mathematical form. So this is called ratios. So generally the ratios can be expressed in terms of times. It can be expressed in percentage form. It can be expressed in rupees also. It can be expressed in proportionate basis also. So this is the way to express the ratios. Then generally the ratios broadly categorized into 4. That is liquidity ratios, activity ratios, it is also known as solvency ratios. The next one is liquidity ratios, capital structure ratios, that is solvency ratios, activity ratios, profitability ratios. These are the 4 types of ratios. That is liquidity ratios, capital structure or solvency ratios, activity ratios, profitability ratios. Now, what are the things will comes under liquidity ratios? So generally, liquidity ratios, it deals with the current assets and current liabilities. That means it can express the relationship between current assets and current liabilities. Liquidity ratios. So generally, liquidity ratios, it can be quick ratio, current ratio. It will deals these 2 types of ratios, liquidity ratios. But ISC point of view, these 2 are very important. Liquidity ratios. So liquidity ratios, it can establish the relationship between current assets and current liabilities. That means how many number of times you can pay the current liabilities by using its current assets. So in that first ratio is current ratio. So current ratio formula is current assets by current liabilities. What is mean by current assets? Current assets are, you know very well, current assets are current investments, inventories, debtors, bills receivable. The next advance tax, other current assets, short-term loans and advances will comes under current assets. That is numerator. The next one is a denominator, current liabilities. What are the items will comes under current liabilities? You know very well because already we completed the financial statements of companies. So current liabilities are short-term borrowings, bills payable, creditors, provision for tax, outstanding expenses, if any, bank overdraft, cash credit. So those items also will come under current liabilities. So the current ratio formula is current assets by current liabilities. So what is the main purpose of this current ratio? So it indicates the how many number of times you can repay the current liabilities by using its current assets. If the current ratio is more, it is better it is. The next one is quick ratio. Quick ratio alternative name is called acid test ratio or liquid ratio. There are three names: quick ratio, acid test ratio, liquid ratio. What is the formula? Quick ratio is equal to quick assets divided by current liabilities. Quick assets means what? That is, quick assets is equal to current assets minus inventories minus prepaid expenses minus that is a stock. Okay, so these are the items. Current quick assets is equal to current assets minus inventories minus prepaid expenses. Okay, these are the quick assets divided by current liabilities. Current liabilities means just now I said. So this is all about the quick ratio. So why we are deducting the stock and prepaid expenses from current assets? Because once we purchased a stock, it may not be readily to convertible into cash, and prepaid expenses also already we incurred, we cannot take it back. So that is why we are deducting these two items. Even advance tax also we have to deduct from current assets, because already we paid the tax, so we cannot take it back. So that is why we need to deduct from current assets. So quick assets is equal to current assets minus stock minus prepaid expenses minus advance tax if any, divided by current liabilities. This is the quick ratio. The next one is solvency ratios. In that solvency ratios, it is also known as capital structure ratios. What does it indicate, the solvency ratios? So that is by using its shareholder funds, how many number of times you can repay the non-current liabilities. So that is the solvency ratio. Solvency ratio is more, it better it is. That means that many number of times you are having the capability to repay the non-current liabilities. So in that, what are the ratios will comes under solvency ratios? So then is first one is a debt equity ratio. Debt equity ratio is equal to long-term debt divided by shareholder fund. Okay, so this is the formula: numerator long-term debts divided by denominator shareholder fund. Long-term debt means what are the items will come. You know very well, already you learned in financial statements of companies. So long-term debts is nothing but non-current liabilities. Those are debentures, fixed deposits, public deposits, and loan from banks, loan from other parties like from financial institutions. These are the long-term debts. Divided by shareholder funds. Shareholder fund means what? Shareholder fund, it is also known as net worth of the company. So shareholder fund means it includes the following, that is share capital, that is equity share capital, preference share capital, reserves and surplus. So these are the items are included in shareholder funds. So debt equity ratio is equal to long-term debt divided by shareholder fund. The next ratio in solvency ratio is debt to total assets ratio. Debt to total assets ratio. So what is the formula? Long-term debt divided by total assets. So long-term debt means, just now I said, long-term debt means that is non-current liabilities. Those are long-term provisions, debentures, fixed deposits, public deposits, loan from banks, loan from financial institutions. Okay, long-term provisions. These are the items will comes under long-term debt divided by total assets. Total assets means you know very well. Total assets is equal to non-current assets plus current assets. Okay. The next one, proprietary ratio. Proprietary ratio, this is also part of the solvency ratio. What is the formula? Proprietary ratio, that is shareholder fund divided by total assets. Shareholder fund means what? That is, I said just now, shareholder fund, it is also known as net worth. So net worth is equal to share capital, that is equity share capital, preference share capital, reserves and surplus. This is a shareholder fund divided by total assets. Total assets means non-current assets plus current assets. You need to consider. The next ratio, interest coverage ratio. Interest coverage ratio formula is, that is EBIT divided by interest. So what does it indicate? Interest coverage ratio. How many number of times you can pay the interest by using its operating profit, that is EBIT. So EBIT means what? Earnings before interest and tax. EBIT. It is also known as PBIT. So EBIT divided by interest, that is interest coverage ratio. The next one is activity ratios or turnover ratio. Till now we completed liquidity ratios and solvency ratios. The next one is activity ratios. Activity ratios, what does it indicates? Activity ratios are those ratios to know how effectively we are utilizing the current assets to generate the profit, that is revenue. So these are the activity ratios. 1. Inventory turnover ratio. Inventory turnover ratio must be expressed in terms of times. Inventory turnover ratio. What is the formula? Inventory turnover ratio. That is a cost of revenue from operations. It is also known as cost of goods sold. Cost of revenue from operations is nothing but cost of goods sold divided by average inventory. What is the formula? Inventory turnover ratio. Cost of revenue from operations divided by average inventory. Sir, how cost of revenue from operations will arrive? Very simple. Cost of revenue from operations is equal to opening stock plus purchases plus carriage inwards plus wages plus other direct expenses minus closing stock. That is nothing but whatever the items will comes under trading account, those aspects we need to consider here. Cost of revenue from operations, these are direct expenses. So again, once again I can explain. Cost of revenue from operations is equal to opening stock plus purchases plus carriage inward plus wages plus other direct expenses minus closing stock. Alternatively, we can calculate cost of revenue from operations is net revenue, that is net sales minus gross profit. Then you will get the cost of revenue from operations. Any one of these two ways you can calculate the cost of revenue from operations. The next, average inventory. In denominator there is an average inventory. Average inventory means opening inventory plus closing inventory by 2. Okay, mind you, wherever inventory will comes, you don't consider the loose tools and spare parts. Okay, while considering the inventory. Okay, while considering the inventory, don't consider loose tools and spare parts. Okay, for the purpose of ratio analysis. So that is average inventory is equal to opening inventory plus closing inventory by 2. So the next, this is the formula for inventory turnover ratio. What is the formula? Inventory turnover ratio is equal to cost of revenue from operations, that is cost of goods sold, divided by average inventory. The next, average age of inventory or inventory holding period. So inventory holding period, it can be expressed in days. So that is days, formula is days in a year divided by inventory turnover ratio. So days in a year, generally we can consider 365 days. However, if the problem specifically provides that assume 360 days in a year, then you have to consider 360 days in numerator. Or they may say 360 days. We may consider 360 days, 365 days or 60 days, 66 days sometimes. So that means depends upon the information given in the problem, you may consider the days in a year divided by inventory turnover ratio. So this is the formula for average age of inventory. That means in a year, how many number of times you are rotating the inventory in a year. That is the main purpose of calculation of average age of inventory. This is also known as inventory holding period. What is the formula? Days in a year, say 365 days, divided by inventory turnover ratio. So you know already inventory turnover ratio that you need to apply in denominator. Then trade receivables turnover ratio. This is also known as debtors turnover ratio. So this is also you need to be expressed in times. What is the formula? Credit sales divided by average trade receivables. Credit sales means from total sales you need to deduct the cash sales, then you will get the credit sales. So average trade receivables. Here trade receivables means debtors plus bills receivable you need to be considered. Then average collection period. What is the formula? Average collection period. Days in a year divided by trade receivables turnover ratio. So days in a year divided by trade receivables turnover ratio. Just like average age of inventory formula. Same way here trade average collection period. That is days in a year divided by trade receivables turnover ratio. The next trade payables turnover ratio. It can be expressed in times. That is a net credit purchase divided by average trade payables. So trade payables are bills payable plus creditors. So here you know very well. So in the absence of information whether it is a cash purchase or credit purchase, you can assume it is a credit purchase. The next average payment period formula is days in a year divided by trade payables turnover ratio. So next ratio in activity ratios, that is a working capital turnover ratio. Working capital turnover ratio is equal to net sales, that is revenue, divided by working capital. Okay, how working capital will come? Working capital is nothing but current assets minus current liabilities. You will get the working capital. So these are the activity ratios. What are the activity ratios? Inventory turnover ratio, that is cost of revenue from operations divided by average inventory. Next one is average age of inventory, that is days in a year divided by inventory turnover ratio. Next one trade receivables turnover ratio, that is credit sales divided by average trade receivables. The next average collection period, days in a year divided by trade receivables turnover ratio. The next one is average that is trade payables turnover ratio, that is net credit purchase divided by average trade payables. The next average payment period, that is days in a year divided by trade payables turnover ratio. The next one working capital turnover ratio, that is net sales divided by working capital. So these are the activity ratios. The next one is the last one, profitability ratios, that is a gross profit ratio, that is gross profit by sales into 100. So gross profit is equal to you know very well, alternate sales minus cost of goods sold, you will get the gross profit. The next operating ratio. So operating ratio is nothing but cost of goods sold plus operating expenses minus operating income divided by sales into 100. This is operating ratio. Okay, what is the formula for operating ratio? That is cost of goods sold plus operating expenses minus operating income divided by sales into 100. This is operating ratio. So that means what extent effectively you are operating during the year. For knowing purpose, we need to calculate the operating ratio. Sir, what are the items will comes under operating expenses? So operating expenses include, that is office and administration expenses, selling and distribution expenses. The next discount plus bad debts plus interest on short term loans and advances and depreciation. These are the items are included in operating expenses. Okay, this is operating ratio. Operating ratio formula is cost of goods sold plus operating expenses minus operating income divided by sales into 100. The next net profit ratio, that is net profit by sales. Here net profit means profit after tax divided by sales into 100. The next operating profit ratio. operating profit ratio. So operating profit is nothing but EBIT, earnings before interest and tax. It is also known as profit before interest and tax. So operating profit ratio formula is operating profit divided by sales into 100. So this is operating profit means operating profit include, that is gross profit minus operating expenses plus operating incomes. So operating incomes means what? That is a commission received plus a discount received. So those items are treated as operating income. So this is the formula for operating profit ratio. What is the formula operating profit ratio? Operating profit divided by sales into 100. Operating profit means what? Operating profit means gross profit minus operating expenses plus operating incomes. Then you will get the operating profit. Okay, the next one. Earnings per share. In shortcut, EPS, earnings per share. It should be expressed in rupees. So what is the formula for calculation of EPS? That is earnings per share. Formula is earnings available to equity shareholders divided by number of equity shares. So that is that what does it indicates? So that is what is the total earning for each share. What is the earning? For knowing purpose, we need to calculate the EPS. Earnings per share. So per share, how much earnings we arrived? That is earnings per share. So earnings per share formula is EA/ESH divided by number of equity shares. EA/ESH means earnings available to equity shareholders. So the next one is price earnings ratio. In shortcut, we can call it as a PE ratio, price earnings ratio. So what is the formula? That is a market price of equity share divided by earnings per share. That is a market price of equity share divided by EPS. That is price earnings ratio. Then return on investment ratio or return on capital employed ratio. What is the formula? Next ratio, that is return on investment or return on capital employed. What is the formula? EBIT divided by capital employed into 100. What is meant by capital employed? Capital employed is nothing but shareholder fund plus non-current liabilities. You need to be considered. So these two items are share, that is a capital employed. Capital employed is equal to, that is a shareholder fund plus non-current liabilities. Okay. So formula for return on capital employed or return on investment is